All right, so welcome. Today we are talking about business formations. We're self-employed, independent contractors, so that has there's a lot of tax things for that can be really great. Contrasting us with some of our counterparts in the lending industry, a lot of them are W-2, so they don't have quite the flexibility that we have. There's pros and cons to both, of course. But for us independent contractors, the default is just you get paid as your social security number. That's how your 1099 comes. And then you file a Schedule C on your tax return, the sole proprietorship. So that's what most people are. And I guess what today we are talking about is how do you decide if it makes sense to incorporate in some way, and what are the different ways that we can incorporate. So just to tell you a little bit about me and why the world I'd be wanting to talk about something like this. Before I was in real estate, I was a CPA, and I did that for not a super long time, but I guess long enough. About 6 years, I was a CPA, and that's what my degree is accounting. And I'm really thankful for that. I actually ended up in a smaller firm, which gave me a lot of small business experience. So I'm really, really thankful for that now that I am a small business owner. I'm so thankful for that background. So that's what we're talking about today is, as a small business, from a tax perspective, what makes the most sense? So I'm going to cover, I guess I'm going to call it 5 different ways that we can be I don't know if incorporated is the right, but what our tax status could be. So one is what I started off, what your default is a sole proprietorship. You're unincorporated, you're just a person with a social security number, and then you file on your tax return. The second way is similar but if you want the legal protection that comes with incorporating, like the limited liability corporation, LLCs, those are the simplest to set up. If you are a single member LLC and you've done that just for the legal protection, then the IRS calls that a disregarded entity. So from an IRS perspective, yes, you're incorporated and you might even have a separate tax ID number, but from a tax perspective, they don't recognize it as anything different. You still do Schedule C. You make note of what your what your business tax ID number is, but other than that, it's a disregarded entity. The third one is a partnership. When you have 2 or more partners, it is a lot the same as a single member LLC, except for you do a joint tax return. It's Form 1065. So if you work with another agent, not your spouse, because with your spouse you already do a joint return, but if you work with another agent that's not your spouse, then you would file this separate tax return together, and then you get what they call a Form K-1, which is your share of the business income and expense. That gets taxed the same way as the sole proprietorship does, meaning that you pay the self-employment taxes on it. And we'll get into all the self-employment tax and how that's all calculated. But if you have a partnership that's not an S-Corp, you get taxed the same way as the other sole proprietorships do. I don't recommend that very often. Generally, even if you do work in a partnership with somebody, it's probably still better to just split your commissions at the broker level and just do your own thing. unless you're really splitting expenses and there's things, I mean, there's always a lot of reasons to do that. Maybe you're sharing an assistant and it makes sense, but you still get taxed that same way. The fourth way is a S corporation. This is where things start to get different. It's still what we call a flow-through entity. So whatever money you make from your company, you get taxed at an individual level. So that's why we call it flow through. You don't get taxed at a corporate level. It flows through to your individual return. The difference is that you would pay yourself as a W-2 employee versus the whole thing being considered your self-employment wages. That is the crux of this whole issue. Like, that's the reason that somebody would do this is the earnings that are beyond what you get paid as a W-2 are then taken basically as distributions, which is more like dividends than it is wages, and it gets taxed differently. You don't pay the Social Security and the Medicare wages on it. We're going to spend some time at the end going through examples where we're really going to get into the nitty-gritty of when does this make sense or not. But that's kind of the meat of the whole thing. The fifth time that we won't spend a lot of time on, but just to kind of make you aware of it, is called a C corporation. This is not a flow-through entity. And we're going to spend more time on the pros and cons of all of these things, but because it's not a flow-through entity, you do pay taxes at the corporate level. And then when you take money out, that's considered a dividend, and then you pay taxes on that dividend. So that's the con. That's why we don't see it very much. The pro is if you do have money that you didn't take out, you still get taxed on it in the year that it's earned. So that can be the con, is you can't necessarily control when you're taxed on it as well. Just whenever you earn it, flows through to your return. But especially if you have a partnership, that can really be problematic. If you all of a sudden get a K-1 with all this income on it, but you didn't see money, that can be an issue. But that's the fifth kind, is the C corporation. So another thing that I wanted to tell you kind of as background as we're thinking this through is if you do incorporate, then you get a different tax ID number than your Social Security number. In order for your broker to give you a 1099 with that tax ID number, that's something that I get a lot of questions on. So I guess I just want to clarify when you can and can't receive commissions in that other tax ID number. Basically, the long and short of it is, in order for anybody, meaning a corporation or an individual, to be paid commissions, you have to have a real estate license. So if you are, if you're trying to get your LLC to receive commissions, it's not legal for your broker to do that unless that LLC has a broker's license. So in order for that to happen, you would need to be an associate broker. When you have a broker's license, when you've passed that broker's license exam, you can only have one associate broker's license. So if you're under another broker, so you're not the primary broker, you're an associate broker, you have your broker's license, but you still work under somebody else, you can only have one of those kinds of licenses. But you can be the principal broker of as many companies as you want. For example, I have 3 broker's licenses. I have a property management company, I have a referral company, and I have Clarity. And that is perfectly fine for me to do that. So if you had your broker's license, then you would get a principal broker's license on, your name LLC. And then it is legal for them to pay your commissions to that different tax ID. However, What I used to do, and I think is totally fine, I've never gotten in trouble for it. The IRS just needs to track it. So if you get a 1099 in your personal name, but you have elected S Corp, and so you have this separate return that has to have a corporate tax ID number. What I would do is to just make sure that they can follow the money. That's what they care about, is tax being paid somewhere. So if you're not able to switch it because of the licensing issue, what I just do is a Schedule C, say I made $100,000 in commissions, just for a fun round number. It would have commission income, 100,000, reported under agent name LLC, tax ID, blah, 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 negative 100,000. So that Schedule C is showing zero income, but we're showing the IRS where to find it. So that's the important part. So you don't have to get a broker's license in order to be an S Corp, but you do have to show the IRS where the money is going. So I just wanted to kind of clear that up, because I get a lot of questions on that from people who aren't associate brokers. You don't have to be one, but you can be one. So now let's talk about, how do you calculate self-employment taxes? That really is the heart of this whole issue. And what that is referring to is Social Security and Medicare. So either way, you're going to pay income taxes, federal, state, Grand Rapids if you live there, or whatever local municipality. You're going to be paying those income taxes either way. There are some differences, especially now that there's a credit that came out 2018. There's a 20% business income credit, and you can't take that on wages. So whatever you pay yourself as a W-2, you don't get that on. So that's why I'm gonna do some examples. I have a little, as CPAs do, I have a pretty cool little spreadsheet that I built. Probably spent too much time on because, Excel is fun. So that plays into things too, but the self-employment tax that we're talking about comes in two parts. The Social Security, which is, if you think back to when you're a W-2 employee, you see your wages, and then you see federal withholdings taken out of there, state withholdings taken out of there. Again, if you have a city that you're paying to, that's taken out. And then you see your Medicare and your Social Security. Now, we're probably all painfully aware that that was only half of what was going to the IRS. The other half was paid by your employer. When you're self-employed, you pay both halves. So it's 12.4% Social Security, 2.9% Medicare, 15.3 total. So you have to pay that. But another thing that kind of factors into when does it make sense, there's kind of like a window, because you do phase out of paying Social Security taxes after earnings of $137,700. You stop paying the Social Security part. You don't ever cap out of Medicare. You continue paying that forever. And in fact, if you make more than $200,000 as a single person or $250,000 as a married filing joint, you pay a surtax for Medicare of 0.9%. So that's fun. And again, this is net. This is not gross. So there's a lot of ways to work it where you wouldn't be making that much. But just as an FYI, that's how things are calculated. Because if you were W-2, your employer would be getting a deduction for those payroll taxes that they're paying. We get the same thing. It just goes on a different part of the return. So of that 12.4% and that 2.9%, half of that is deductible to us. So that's kind of what we're talking about. That's a chunk of change, 15.3%. If we can get away from that, that really adds up. Now, you can't ever get it to zero unless you are legitimately not in the day-to-day of your business. which I think is uncommon for realtors. We're just in a personal type business, but I suppose it's not impossible. So that's another question that I get all the time. Like, if I did do wages, how much would I need to pay myself? Because that really factors into, does this make sense or not? And the reason that's a question that comes up over and over again is because the answer is, it depends. Basically, when we make an S Corp election, what we are saying is not all of these, all the revenue that came into this company, they weren't all there because we earned them. Some of it is passive income. So like, if you really, the best case for it is when you have employees. Some of your revenue is there because of the effort of your employees. So I think as a, like a first sniff, not that it doesn't make sense sometimes if you don't have employees, because there are other ways to get passive income. You know, we have vendors and that kind of thing, that we could say some of this was due to the efforts of such and such vendor. But I think the case is the clearest when you have employees. The other reason it makes sense to wait until you have employees is then you're doing payroll anyways, especially if you're paying them as a W-2, which maybe that's a different topic for a different time to decide if your assistant has to be W-2 or 1099. There are definitely guidelines for that, and it depends on a lot of different things. But if you're already paying somebody as a W-2 employee, then you're doing payroll anyways, then it makes a lot more sense, because that's part of the cons of incorporating, is the expense of running payroll. Even if you only do it once a year, your CPA does it when they're filing your return. You have to pay your CPA to file those extra returns. So it's just kind of an expense to keep in mind. So, okay. Now that we kind of have some background, I'm going to dive a little bit deeper into the pros and cons of each of the 5, and then we'll show an example. Sole proprietorship, pro. It's the simplest. Tax returns, the cheapest. It's really much more straightforward than the others. And again, you need to be able to justify that some of the income was earned passively. And the pro, that you get that business tax credit. That is new in 2018, so that hasn't always been a part of this discussion, but I think it bears mentioning, because 20% isn't nothing. But that's a reduction, not a tax. So 20% is a reduction, 15.3% is a tax. So it still makes sense a lot of the time. Partnerships. It still flows through, but it's subject to the self-employment tax. So the pro is it makes it easier to split up your income and expenses if you work with somebody else. The cons are you still have that self-employment tax. S corporation, this is a pass-through. The pros are it takes some income through distribution, which avoids that self-employment tax. All of the income is reported on Schedule E through K1 and W-2 wages. So that's the other thing that that's not a tax advantage per se, although I've heard people say that if you're an S Corp, you're less likely to trigger audit. And if you do, they're not auditing everything. They might audit your 1040, your personal return, or they might audit your 1120S, your corporate return. But auditing the business doesn't mean auditing your personal. It gets it off of there. So it's just a line item. Instead of being everything under the sun on your Schedule C, it's just your agent name, LLC, and then a dollar amount. And that's all that makes it onto your 1040. So there is something to be said for that. That would be a pro. Cons, you pay yourself through payroll. So you have all the complications and expense of payroll and payroll taxes. Now, there are a million different services for this. I think they earn their money. You don't want to get in trouble this way. Like Paychex is one I used for a long time, ADP. There's a million of them out there. But it's not free. It depends on how many employees you have and that kind of thing. But, you know, it's somewhere $50 to $100 a month, depending how often you run payroll and what all you need them to do, that kind of thing. But now I do taxes through through QuickBooks. They have like a payroll module. So I put all the money to the IRS and the state myself. I feel confident in doing that because of my CPA background. But if you didn't know exactly what forms needed to be filed, where and when, that's something you don't want to forget. You don't want to be like, oh man, last quarter I forgot to do my 941. Like, that's not something that you want to screw up. So if you're not really, really confident, then it is worth the $50 to $100 a month to pay a service to just do it for you. All you do is you call them, you tell them your hours, and then they do everything else. They do the direct deposit, they do all that stuff. So if you're going down that road of W-2, I think it's worth the money. I do know a lot of people that do it at the end of the year too. Like, they just kind of pay themselves like normal, and then at the end of the year, their CPA does their thing. That's a possibility too. The other con of S Corp, like, I probably did mine too early when I got into it, because the con is your return is so much more complicated, and so it's more costly. You know, it'll probably cost you $1,000 to $2,000 more in tax return prep. If I were to guess, I guess it depends on your CPA, but so it's not nothing. It's not the end of the world, but it's not nothing either. So just to keep it in mind, it does get a little bit more complicated and it gets a little bit more expensive. But the pros of avoiding the self-employment and the lessened exposure to audit might be worth it. C corporation. Again, this is not a pass-through. Still shows up on your tax return, but only as dividends and wages. Again, this is really, really unusual for an agent to do it. You really don't see it except for much larger corporations. I don't see it in small business hardly at all. So now I think this will all come together by looking at some examples. I'm going to share my screen here. Can everybody see it okay? I can't see chat as well when I'm sharing my screen. So if you do have a question or something, it's probably, oh, here, maybe I can pull it up. It might be best to just unmute. Like I've told you before, you just hit that space bar and it will unmute you. But so here's an Excel sheet. Hopefully you can see the whole thing. You're seeing what I see. I did 3 different ways, and I'll kind of go through what's making this up one by one so you can kind of see what I'm doing here. But I did with 3 different like commission income levels and contrasting if you're a Schedule C versus if you were an S Corp. So in this first example, I did for somebody who has gross commissions of 150,000. So to keep things simple, I'm presuming that if you do have a buyer's agent, that you're not paying them, that your broker is. So your business expenses are going to be more so admin that you pay, and advertising, you know, printers, the like of that. But so that's, for simplicity's sake, that's what I'm assuming. The other thing that I'm assuming, just again for simplicity's sake, is that you don't have a spouse that has income, because obviously that changes your total income scenario. And I'm assuming that you're married filing jointly, because that does change like what tax brackets you're in, that kind of thing. If you're single, things look a lot different than if you're married filing jointly. So just for simplicity's sake, I picked one for no particular reason that I picked one or the other, but just to pick one. But the point being, talk to your own tax professional about what your picture would look like, because if you do have a spouse with income or you're single, your brackets are going to be different. I'm just trying to make a point here of the different ways that things are impacted at different levels, and when it would make sense and the kind of difference it would make. So I did kind of one in the middle, one that would be maybe an example of you're on the edge, but it might not make sense yet. And then another one where you're maxing out of Social Security and it starts to make slightly less sense. So middle, low, high is kind of what I was doing here. So if I look at the first one here, if you're Schedule C, you have 150 in commissions, 30,000 in business expenses, gives you a net income of 120,000. That is all business income. That's the only thing you have on your 1040. So that's your total income. We're going to take away from that the standard deduction. Again, for simplicity's sake, I am assuming that you are not itemizing your deductions. Not to get too much in the weeds of the whole tax picture. Deductible payroll taxes, that is the Medicare and Social Security taxes that you pay, but just half of them are deductible. And then this great qualified business income deduction. This is 20% of your business income. You don't get this on wages, so that's why we want to make sure we're taking a look at that. So that brings us for Schedule C, taxable income of 62,000. And then the tax brackets, I wasn't sure a good way to do these numbers in a spreadsheet format. The bottom level, well, the bottom level is 10%. But if you make more than 19,400, you max out of that. So I'm assuming that everybody makes that. So if we're in that level of 19,000 to 78,000, then you're taxed at 12%. Once you have taxable income over that 78,000, then the amount over 78 gets taxed at 22% instead. So I basically did it as a 10% surcharge. Then you have the Social Security taxes and Medicare taxes. So in the case of somebody at 150,000, and we can play, I mean, it's an Excel sheet. So if anybody wants me to run different numbers and say, what about this, what about that, I can do that. In this case, it does make sense. And here's why. So if we go to the S Corporation column, you have, again, the same exact thing. Commissions received 150,000. Business expenses, I bumped it up just a tiny little bit because it does cost more to do your tax return and such. And then I said 60,000 of that is wages. Now, again, we can make arguments in all kinds of directions. What's a reasonable wage? But you do have to pay yourself a reasonable wage. That brings your business income down to 58,000 instead of 120,000. Your total income is the same, except for that additional amount on tax return prep. Standard deduction is the same. Deductible payroll taxes, because you'd be paying less in payroll taxes, the amount that you deduct is also less, of course. That qualified business income deduction is less because that is based on that net business income of $58,000 rather than the full $120,000. So your taxable income is higher. It's $77,000 versus $62,000. So that's not looking great for us at first, except that it's only the $60,000 that's subject to the Social Security and Medicare taxes versus the entire $120,000. So your income taxes are higher by almost $2,000, but because your Social Security and Medicare taxes are in half, it ends up saving you about $7,000 in this example. So that's worthwhile in my mind. Let's contrast that to this example with if our gross commissions were only $75,000. So in this example, we have the 75. I'm going to say they're probably about half what the other guy is spending on business expenses. Again, these are kind of out of the air. So don't take this as a guide of what your expenses should be or anything like that. I'm kind of pulling it out of the air. But somebody making 75, I guess I'm presuming, they don't have a full-time admin, maybe a part-time advertising, that kind of thing. And then your wages of 40,000. I think if your commissions are less, I think a reasonable wage would also be lesser. So what makes it onto the 1040? For your Schedule C, you have that whole 60,000. As an S corporation, again, I did 1,500 as tax prep. So the total income is about the same. Run it down, standard deduction, same. Payroll taxes aren't that different. You have that qualified business income deduction. That's quite a bit different. So income taxes are about $1,000 higher. You do still save in the Social Security Medicare tax because it's 40,000 instead of 60,000. So you save about $2,000, but you spent 1,500 on doing payroll taxes, you know, doing your tax return, and the additional, you know, just pain in the tail of doing these extra returns and stuff. So in that example, it probably doesn't make sense. Then if we end this example with the 250,000, what I was trying to do there is show how it does start diminishing because they have maxed out for Social Security. That maxes out, like I said, at 137,000. So the Schedule C is maxed out because they have net income, business income of 180. The S Corp does not max out because they're paying themselves 75,000. So it still is a savings, but maybe not as dramatic in terms of percentages. You know, you'd think if somebody's making 150 versus 250, that that their savings would be that much greater. But it's kind of the rules of diminishing returns, where it doesn't end up being as, I mean, it's basically the same at 150 versus 250. In this example, obviously there's a lot of assumptions that go into this, so don't take this as a rule, but you can see that in this example at the 150, they're saving $7,000. And in this example with the 250, they're saving also $7,000. Still worthwhile. I'd still do it. Somebody at 250 level most probably has a couple admin or at least one full-time. So I think the theory is there. But then as you know, as your income grows, the benefit that you get from it isn't quite as dramatic. So that is just something that I find interesting. And again, there's so many things that are assumptions that we make in here, like what's a reasonable wage. I would really have a deep conversation with your accountant about it. I think has to do with the hours worked, percentage of the income that you bring in, all kinds of things. You just want to document it. I don't know how often the IRS turns that over and calls it an unreasonable wage, but I'll tell you what an unreasonable wage is 0 or even like 10,000, something like that. You need to at least be making minimum wage and probably better than that. But so there's a lot of assumptions that go into these numbers, but okay. So those are kind of what I wanted to show. So I guess I hate to be too short. I gotta be for an hour, but those are the majors. I definitely have covered all the majors. So if somebody has questions, please bring them up. But the majors that I want you to know is you do have to have a license to get commissions paid to that entity. So you'd have to deal with it another way if you don't. An S corporation, the theory is only right if you have an employee. Social Security is 12.4%, Medicare is 2.9%. That's what we're trying to avoid. But it only makes sense if your income's high enough. You do lose the qualified business credit on the amount that is your wages. So that can be offsetting a little bit. And a lot of it just depends on your brackets. So I can't let you go yet. Somebody asked me a question, but that's really my whole outline. What is the advantages of an LLC? The advantage of an LLC is really for legal purposes. So, and again, you'd want to talk to your attorney about this, but it basically lets your assets not be commingled with all your personal assets if, heaven forbid, you get sued. I don't necessarily deal with it that way. I think that you can mitigate a lot of that same risk with insurance. So we do have errors and omissions insurance. That's really important to make sure that you have that and that you understand your deductibles and such. We had to make our first claim, I don't know, I guess a little over a year ago, and was so thankful. We didn't have any deductible. It was great. It was a pain. That agent had to go to court and that kind of thing, but as from an E&O perspective, covered really well. The other thing that I would recommend getting is an umbrella policy. And it just is basically, if you get sued for anything, there it is. So you have tenants that falls under your umbrella. So I just have a pretty high umbrella policy so that I don't have to worry about the tax formation from a legal liability perspective. But that's probably the best advantage of an LLC. And the other thing that it does, and it doesn't do this if you're a single member, but if you're a partnership, it gets it off your return so that you don't have that audit exposure. Jen says, put money into a SEP IRA, pay health insurance premiums, also help lower the income as well. So Julie says that her husband went to an LLC and it helped decrease the quarterly payments. Did he do S Corp? Or just from being an LLC? Because it shouldn't make that big of a difference if he's still being taxed. But you can be an LLC and yes, S Corp, yeah. It depending on your income level, like we you know, in those couple examples that had a lot of assumptions in them, you know, $7,000, that's not nothing. And it can really vary from there. I know I've been an S Corp for many years now, and I'm glad for it. It gives me a lot of flexibility in a lot of different ways. And I don't know if I know what you mean, Anna. What do you mean the best site? Do you mean like, is there a list of things that we can deduct? I don't know that there's a site for that. I know this is a frustrating response in a way. It's not necessarily the kind of thing that you brainstorm per se. I know I did a tax seminar recently, and that was a couple of the comments that I got is, I think people were thinking that I'd be able to tell them some magic things. What's that magic deduction that's out there? Basically, anything that you spend on your business is deductible, as long as it's reasonable and ordinary. Now, there are a lot of different, there's a lot of different things that do have rules around them. Such as like office in the home. That would be one where you don't necessarily have like a check that you're writing. But one thing that I will say, if you have an office in your office, you're not eligible to take office in your home. So be aware of that. That's sometimes a reason. If you're never going into the office, let go of your office in the office so that you can deduct your home office. Oh yeah, Carla says your mileage. Yeah, for sure. There's a lot of different ways to track your business mileage. Well, not really a lot. There's two. You can do it based on actual or business. Actual a mileage rate. That's the simplest by far. I use the Mile IQ app, which is really great. I haven't been driving barely at all lately, but I'm starting again now. The only thing that I can think of that really has like limits to it that you can't deduct is gifts. That would probably be a thing that we'd want to be aware of. The other thing that has had a pretty big change recently that's really good for us to be aware of. I know I do a lot of client events. Entertainment is 0% deductible. It used to be 50% and now it's 0. So food is still 50%. So if you do an event where you have all your clients out to watch a baseball game with you, all the tickets for the baseball game are not deductible. The hot dogs that you buy them are 50%. So it's important to make sure that you're segregating what's food versus the entertainment. And see if there's a way to call it something else, of course, but at its heart, they don't like you whining and dining the clients doing these expensive things. I don't think they're after us little guys when they make those policies, but it affects us nonetheless. Yeah, so Dawn was saying that she has LLCs for each of her properties. If you're a property manager, that's a whole nother realm and something that is, but Dawn, I would guess that for tax purposes, they're disregarded LLCs, that those are legal liability protection versus you're probably not S Corp for each of those properties. So like I have an LLC for my building that I own. And It's not even, you don't even know that on my tax return. It just says 600 bridge, and that's it. It's disregarded from a tax perspective. The other thing that is potential negative for having LLCs for your rental properties is the impact on your ability to get a mortgage. So that's why I advocate like just having a ton of insurance, just in case. You'd hate to have an issue with your mortgage. I do want to do a call someday, and I just don't know enough about it. I got to get my CPA to help me, and those are always harder when I need help. But on opportunity zones, then you have to own it in an LLC, and it has to be in these zones. But it is a great way to not pay capital gains taxes. It's huge. Something I'm really excited about. I haven't been able to take full advantage of it the way that I'd like yet, but man, something that I'm really excited about. Yeah. So I think we're almost to the time where I can let you go. Sorry that I'm kind of flailing a little bit here. There's enough to it that it's almost an hour, but it doesn't quite get me there. Yeah, there are still capital gains. Well, not in an opportunity zone. As long as you hold it for 10 years, there's 0 capital gains. And that is amazing. That's why I'm so excited about it. You do have to hold it 10 years. But it kind of functions as a 1031 exchange also. So if you have a property not in the opportunity zone that you sell, and then you roll it into an opportunity zone property, you have to hold it 10 years, but then you pay 0 capital gains on either one of the properties. Like, that's really cool. That's a ton of money potentially, but you have to buy it in an LLC. It has to be in an opportunity zone fund. So you have to be able to find a mortgage that's going to lend to you as an LLC and not an individual. But man, so cool. So I guess what I hope you get out of this is go talk to your CPA about your specific situation and when it makes sense or not. If anybody that has an assistant should for sure be having that conversation. That is for sure when it makes sense. And even if it's not somebody full-time working just for you, but if you have somebody that you leverage, that's when you need to be asking these questions. Robert, go ahead. You can unpause yourself, or I can maybe do it for you.
Can you hear me?
Yeah, there you go.
Got a quick question. So you're saying, if I understand this correctly, opportunity zones, 10 years, no 0 capital gains, which is a good thing, but you can't buy it as a private person. It must be a LLC?
Correct. It has to be done through these opportunity zone funds. So it's an LLC that's dedicated to buying properties in these opportunity zones. It's geared primarily towards, more commercial. They're talking about creating jobs and such, but it doesn't have to be commercial, but it does have to be through an opportunity zone fund.
What about is there an LLC, an opportunity zone map?
Yes. When I send follow-up, when I send follow-up, I'll send a link to that. I want to say it's like miopportunityzones.com, but I'll double check that, but I'm pretty sure that that's what it is.
So an out-of-state investor can buy a property here, obviously here, opportunity zone, keep it for 10 years and have 0 capital gains.
Yeah. And it's a national program. It's not just here, but it is managed through the state.
Okay. I have somebody in mind right now. That's why it just made me trigger that thought.
Yeah. And it does have to be, like you said, in the map. So it's not going to be, like downtown East Grand Rapids, or it's going to be areas where they want economic development to happen. So it depends on the comfort level of your investor, but it's not like all terrible areas. There's opportunities. Like, there are areas that I would be excited to invest in.
Oh, okay, cool. Thank you. I greatly appreciate it.
Yeah, it's really cool. That might be the one thing you get out of this seminar that could make you thousands of dollars. I'll tell you what. And then somebody asked, can I use the same S Corp that somebody else is already using? I wouldn't. They're easy enough to set up that you might as well do a separate one. And because of the audit reasons, if your husband's S Corp gets audited, then you just got audited. I think it's better to keep them separate. Because you'd have to pay yourself your own W-2 anyways. Sounds like Chicago Title is going to be doing a webinar on opportunity zones. That's cool. Yeah, I want to go to that because that's the thing that I get really psyched for. But yeah, so I think we made it. We got our full hour of Con Ed today, legal Con Ed to boot. So thank you guys, like I said, for making a successful series. I appreciate everyone who's been here. If you have any other questions or maybe something about your specific situation or anything like that, please feel free to reach out. We do have a Facebook group called Clarity Conversations where we post like follow-up information. And we will have that on there. Molly, you got everybody?
Yes, I have everyone.
Okay. Well, great. Well, go sell some houses.